think we'll go ahead and get started. Can everyone hear? I think there are seats still up front if people in the back want to have seats. By quick introduction, my name is Iqbal Branch. I head up marketing for Advantage Futures. I want to thank everyone for attending today. This is our 12th seminar this year, and I think probably our best attendance. Hopefully it's not just because of the free beer and wine. Quickly, I want to thank the folks at Fundamental Analytics for co-sponsoring this event, as well as the CME Group for hosting. We've got representatives from both firms here, and I want to point out Angie DiCarlo. She's here in the back. She's the Associate Director of Energy Products, so if you have questions specific for the CME Group, feel free to track her down after the presentations today. Before we get into the panel, I just want to give a quick introduction to Advantage Futures for those of you who don't know who we are. Advantage has been around since 2003. We're a full FCM clearing member firm of 14 different exchanges. We've been number one in electronic volume at the Board of Trade prior to the CME merger. We have 7 data centers with direct exchange connections. We have a 24-hour global execution and technology support desk, about 100 employees. This year we hit $374 million in client funds, which is about a 30% increase over last year. In 2008, we cleared 310 million contracts, and to date, we've cleared over 1.5 billion contracts. Advantage has really been founded on a couple of things. One is our superior technology infrastructure. Just want to quickly point out one of the services that we offer are server co-location services, both here in Chicago as well as in Frankfurt, Germany. And we do a lot of support for algorithmic trading and low latency trading. One of the other things, customization and convenience. We don't offer our own front end, but we do support all the major front end providers. I think there are some of them here today, and we're happy to consider others that we don't fully support. The other thing that really sort of allows Advantage to stand apart is our client service. We often joke that when you call Advantage, none of us have voicemail because you'll always get a person on the line, and our clients really seem to appreciate that. The other thing that I want to mention is, especially in these times, risk management. One of the things that we offer is our Disaster Recovery Center, which is in Downers Grove, about 30 miles outside of Chicago. And that's a live trading center. We have about 100 trading spots out there, as well as being the disaster recovery for all of the trades that we clear. We actually have some traders down in Houston who use it as their redundant backup as well. So in the case of a hurricane, they can close shop down in Houston and just fly up here, send a couple traders up, and be up and running in no time out of our Downers Grove facility. And then finally, just competitive pricing. There's a number of representatives here from Advantage Futures, and feel free to stop one of them or myself. You can send an inquiry into our website or call if you're interested in starting to trade with Advantage Futures. And I'll say finally, this has been a great year for us. We did reach 1.5 billion contracts cleared to date, and as I mentioned, 370 million plus in client funds. With that's all I'm going to talk about as far as Advantage Futures is concerned. I want to turn it over to Chuck Mackey, who is the Director at Fundamental Analytics, Director of Business Development, and he's going to introduce our panel today. Thank you very much.
Thanks, Iqbal, and thanks everyone for joining us today. As Iqbal said, I'm a Director of Sales and Business Development at Fundamental Analytics. I'm not going to go in and take a lot of your time here today to tell you about what we do, but kind of the heart of this presentation goes to what we are as a company. We provide software as a service, consulting, and publications that are aimed at the professional commodity trader that helps to inform and reveal the impact of fundamentals in the market of supply and demand and how that impacts price and volatility in what you're trading. We cover the energy markets of crude oil and natural gas as well as grains. There's also representatives from Fundamental Analytics here, myself, Joel Fingerman, who'll be our first presenter today, as well as Chris Berg, who's at the back of the room here. So if you want to get some more information from us later on, I encourage you to do that as well. Our idea here in coming up for this afternoon was self-serving to a certain extent, but it's also by the acknowledgement and the understanding of how much energy trading it has grown in Chicago and how much it continues to grow. And we started what we call Energy Chicago with the idea of making regular meetings such as this, bringing in experts in the energy space to talk about the markets and to bring knowledge and bring the community together for energy trading. We have a group on LinkedIn, so if you're on LinkedIn, look for Energy Chicago. We welcome all comers. We have started just a couple weeks ago and have about 60, 70 members right now. Today we're going to have 4 speakers. You've seen the lineup. Our first speaker is Joel Fingerman. Joel is the managing partner at Fundamental Analytics. Joel founded the company in 1985 with a focus on quantitative analysis of supply and demand as an indicator of price and volatility in commodity markets. He has worked for myriad companies along the way, including Shell Oil, Vitol, ConocoPhillips, to name a few. Joel has a PhD in mathematics from the University of Chicago. Joel?
Thank you, Chuck, and good afternoon to everybody. I'm glad you could all come. What we had hoped to do with this afternoon is to kind of cover quickly and succinctly the various areas of energy, that kind of where we are in this end of the third quarter, beginning of the fourth quarter, where we see things going, and how we kind of understand the markets in energy. I'm going to be talking about crude oil and refined products, and then my colleagues will be talking about natural gas and ethanol. So I'm going to try to keep this brief and bring up a whole bunch of stuff very quickly, and I will be around along with my colleagues after the presentation. So if I flash through a few that you still have questions about, please feel free to buttonhole me then. We can talk about it. What I've listed here in our current market is we have very choppy price action currently in crude. It's remarkable to say that crude is trading between $65 and $75. Used to be a few years ago that if you had a $10 range in crude for the whole year, it was considered a major move. And we're seeing this in a matter of days that you could have a $4 to $5 range. So it's a very choppy market. It's very frustrating to a number of the trend followers because it gets up to 75 and they say go long and then they get hurt. It gets down to 65 and they say let's sell here and then they get hurt again. And it keeps bouncing back and forth. The Contango, which I'll talk about in a minute, has decreased from as much as $7 at the beginning of this year to now down to around 35, 40 cents. What's going on? Well, the fundamental factors, as we see it, is we're looking at lower crude runs, ultimately, lower imports of crude. There's always the talk about the U.S. dependence on crude oil, although that's dropping right now, and lower crude stocks. We look at decreasing contango or carry in the market, which I'll talk about, and the other fundamental factors, kind of global economic factors which are going on now, is the weak dollar. There's been strong inverse correlation that every time the dollar drops, you see the move from the dollar into commodities, and you'll see a strengthening in the crude market. Similarly, as the equity markets do improve, you will tend to see an improvement in crude prices, and if indeed we do have a significant recession recovery, we will see probably increased prices in crude. There's a lot of view that in the long run we're going to be way up at the high numbers sooner than later. I think that's questionable. And what I'll mention for you to kind of watch, keep an eye on, as I say, is where the total crude stocks are, where they're level in direction. And I'll talk a little bit about crude stocks at Cushing, Oklahoma, which is the delivery point for the NYMEX contract, which has a big effect on the contango and backwardation. And then lastly, the backwardation contango in the market. This is just a quick bar chart of crude oil prices where we were back here at the beginning of the year sitting at the $40, $50 after it collapsed last fall has rallied up to the $75. And since basically May, it's been sitting in this $75 to $65 range. Today was another up day of about 85 cents, was actually led by the products. But until these issues get sorted out, our view is that it's going to remain choppy here. That I'm not one to fade these markets. I wouldn't be a big seller at 75. I certainly wouldn't be a big buyer there either, because it tends to bounce off these numbers 65 to 75. Now, what's been happening is the contango in the market. What is that? We're talking about the difference in the front to back, first month to second month crude spread. And back here in this red line and black line, they're kind of hard to distinguish, are the price of the front month and the second month continuation of crude oil prices, where we got up last summer to the $150, $145. This is a weekly average, so it smooths out the numbers a bit. And what we see is these green spikes denote, positive spikes denote a backwardated market where the front of the market is more expensive than the back. And when you get into these negative spikes, you're looking at a contango market where you have carry. What was happening back here at the start of this, I just lost the mouse. There we go. At the start of this is basically the Iraq War. When we went in and we had some strong backwardation, there was concerns about fuel availability. As the war went on, and then we got into 2005, 2007, there was issues about India and China and the long-term demand. So the back of the market was bid up, so you had this contango market despite a rising market. And then we saw the climax when we got to $150 crude a little over a year and a half ago now, and then it collapsed. And we went into very steep contango in January of this year, where it was as much as $7 between the first and second month spread. And if you had ability to storage, it was a guarantee as much as 25% return on your money at that time. We've been now working our way out, and you can see with this chart that you really have long-term kind of continuation of these trends. And as of last week, last Friday, we were averaging just down to 34 cents in contango, which means now that the economics do not favor storage, so that there isn't a good money market reason for putting oil in storage. And so what we're looking at here is the crude oil stocks, which had peaked in May as the buildup and have been coming down from their peak at roughly 375 million barrels to the latest number at 337 million. And we expect, because of the low contango, that we could probably see more downward pressure on that. As you have downward pressure, they feed on each other. As you have downward pressure on stocks, and here and specifically is in Cushing, where the delivery point for the crude oil came off some highs of almost 34 million, now down to 25 million. You're going to see that tightening. And as it gets even further, you're going to tighten. So the tightening of the contango gives support to the crude market, and it would probably just bounce around in this range. Crude runs, meaning how much are the refiners using, has been at historic lows. These big dips you see here are the hurricanes last year with Gustav, in 2005 with Katrina, where the refiners can't be operating. But if you take those out and you look where we are now, the refiners are definitely cutting back. They don't need the crude. And so therefore the imports have also gone down on crude. So the things to watch, as I mentioned before, is kind of the imports, the runs, and where the levels of stocks are. Was that fast enough for you? I can speed up a little bit if you'd like. All right, real quick, gasoline market. We have lower outright prices from a year ago, but we have significantly lower crack spreads, which I'll talk about. What is causing that? Well, we're looking at low demand and surprisingly high production by the refiners and high stocks. The fundamental factors to watch is the gasoline implied demand. And what that will show us, whether we're getting high production, high stocks, and whether we see the high days forward supply go away. The geopolitical factors here is the issue of unemployment and what has been called the jobless recession recovery. And despite the fact that we're coming out of the recession, unemployed people aren't driving to work, so your basic car demand for gasoline is going down significantly. So what to watch? We watch for the gasoline implied demand. We watch at the total stocks level, where they are and the direction they're going. We look at the production by the refiners and days forward supply. So here's our gasoline prices. I'm just using the November contract for a comparison. This is a year-on-year overlay. Here was last year again in July, where the November contract got up to $3.50 in the wholesale market, and we were seeing $4 gasoline at the retail market. And it collapsed into November. And we're looking here, the black line is this year has been significantly below that. That's why we've seen a little bit of an uptick in demand because of the relatively lower prices. But it's not going anywhere. But the real key is what we call the crack spread. This is the formula difference between the cost of gasoline and the cost of crude oil. It's called the crack spread because you think of a refinery as a big distillation unit. They crack the crude oil into gasoline, and so the refiners refer to it as a crack spread. Notice here, back when it collapsed last year, the crack spread was actually negative $2. I'm usually accosted at dinner parties why the price of gasoline is so high, and it's all my fault. And I was explaining to people then, that was a joke, I'm sorry, but I was explaining to people back then that crude oil prices had collapsed from $150 to $40, but the general public didn't realize that gasoline prices had dropped down to less than $40. It was actually running at $30 to $35. So the refiners were actually losing money for the gasoline that they were making at this time. It's been pulling out, as we see, over the course of this year. We got a little bit of a bump in August, and then it's been actually collapsing. And we're sitting here now at roughly $2.30 as of yesterday's settle in the gasoline crack. It takes a refiner somewhere between $3 to $4 to make a barrel of gasoline. They're losing money right now on the gasoline contract. It's hard to believe, but that's actually what's going on if you track these gas cracks, which are kind of the key indicator for the refiners. So what's going on? Let's look at demand. Demand is off from last year. We have a seasonal bump in the summer months with the vacation driving, but we're now sitting at levels equivalent to 2004, despite the increase in the population and the increase in number of cars. So demand is off. But look what production is doing. I don't know what the refiners are thinking. They're trying to get the last barrels out and make some money here. But this is, as the last week, this is what the refineries were producing, 9.4 million barrels. By the way, a little note here. The total gasoline demand is really around 9.5 to 10 million barrels a day in this country. That's 42 million gallons of gasoline, which are consumed in this country every day. We don't make enough in the domestic refineries to supply the U.S. demand. And what is not talked about in the popular press is the dependence on imported gasoline. We actually import gasoline from Europe and elsewhere to make up the demand of the refiners. There hasn't been a new refinery built in the last 30 years in this country for EPA reasons and others. But they're pushing right now to try to get the last gas out of this, even though they're losing some money. So as a result, with low demand and high production, the stocks, relatively speaking, for this time of the year are fairly high. And here's where they were last year. If we take the demand number and divide it into the stocks, we get a thing called the days forward supply. And right now we have about 21 days of forward supply of gasoline, meaning if the producers just stopped and we lived off of inventory, we could run for 21 days without having to make any more gasoline. But as you again see, where we were last year at this time, we have this is a good chart because it normalizes the stock levels vis-a the demand, and we're at just all-time high levels right now. Okay, one last piece, the distillate market, heating oil and so on. Again, we have lower outright prices, significantly lower crack spreads, and again, lower demand, but normal production and therefore very high stock levels. Again, the major factor is implied demand, the distillate demand that's there. Even though we have normal production, we end up with high stocks and very high days forward supply. The thing to watch here, the geopolitical or larger economic factors, are commercial vehicles. Because heating oil, as it's traded on the NYMEX CME, is indeed used for heating, but it's only about 12 to 15% of the market actually uses heating oil for heating purposes. It's all the trucks and the off-road vehicles. So what you're really going to watch is the FedEx trucks, the UPS, and so on, to see how they're doing, because that's what's going to tell you what your distillate demand is all about. We won't have as much of a winter season anymore. And the other piece to that is then the recession recovery. If indeed we get more industrial demand, we'll see more demand for the distillate, the middle distillate fuels. So again, here's the November heating oil contract and the prices, how it ran. year on year for the last few years, and we're sitting here significantly lower than last year at this time. But then we look at this heating oil crack spread where, again, it exploded last summer at $40. We're sitting right here now at $6. And the only thing that, in a way, which may save this is we actually have to export to Europe because they can use our excess distillate fuels. Implied demand is, again, low from previous years. We're down at the level of 2004. Production is not low. It's been running at normal to above levels. And so here's the kicker. Here's your distillate stocks. We are basically off the charts, and we have been this way for many, many weeks. And if you take that demand number and divide it into the distillate charts, you're sitting at a days forward supply of 40 days of days forward supply for it. So do I sound a little bearish on the product prices? I am. That's the conclusion you can draw. So what we're looking at is bearish fundamentals on the refined products, kind of stabilizing possibly on the crude oil prices, and what's going to happen is you're going to get a squeeze on these crack spreads. Thank you.
Thank you, Joel. I didn't do a very good job of explaining the format beforehand, but we're going to have everyone give their presentations, and afterwards we'll have a Q&A session. And then after that, we, in this idea of community and sharing ideas, we'll be hanging around. There's beer and other refreshments, and we'll be taking care of that. We'll be planning to stick around until 6 o'clock or so. Our next speaker is Dave Ware. He is currently manager of market strategies for Integrys Energy Group. He is a 20-year veteran of the natural gas industry, having held a variety of positions in information systems and gas supply at Integrys. Dave holds both a bachelor's degree in geology and an MBA from the University of Illinois. Dave? Yeah. Not in football.
Yeah. Speaking of colleges, though, when Joel was in our offices last week, he confessed that he was a former university professor, and sometimes he slips into his old habits. Well, I have to confess, too, I was the kid in the back row of the lecture hall falling asleep, so sometimes I fall into my old habits, too. But the title of my presentation is Current Market Conditions in Natural Gas, and I was initially thinking of calling it Methane, a riddle wrapped in an enigma, shrouded in mystery, but then I realized that T. Boone Pickens had used that back in 1986, so I abandoned that idea. And if you don't know who T. Boone Pickens is, you better Google him tonight before you go to bed, because he's a pillar in natural gas. Well, anyway, whatever you want to call the presentation, hopefully people will come away with something that they either find useful or interesting or want to find something else about. So let's get started. First of all, why me and who is this Integrys stuff? Integrys is a holding company of regulated and non-regulated subsidiaries that are engaged in energy delivery in the U.S. and in Canada. My colleague Brian and I, we work for a support unit that kind of overlays the entire organization, but are primarily in charge of supporting the gas utilities. We have 4 gas utilities, 1 electric utility, and 1 combined utility, all serving customers in the upper Midwest. Combined, there are 1.7 million natural gas customers. We've got annual throughput of about 400 BCF a year and a peak day send out of about 4 BCF a day. So even though we represent a group of stodgy 150-year-old utilities, we do have some skin in the game. These are what I like to call the key characteristics of the physical gas market. As Chris mentioned, I've been in the industry for about 20 years now, and I can attest to the fact that it is very robust. Even after the Enron meltdown and there was some consolidation of the industry, there are many active players out there. It's a very active day-ahead spot market, and we transact with literally dozens of counterparts for spot transactions and structured term transactions. and this leads to a lot of liquidity in the market. The CFTC and the FERC are also really big on price transparency and open access. A lot of proposed legislations out there for enhancing that. And I think that the market really follows that paradigm quite well. But in addition to being liquid, the infrastructure is very mature and very efficient as well. Our old cast iron pipes that are out there today, you know, they may not have smart grid technology, but that's okay. Natural gas will move from high pressure to low pressure pretty easily. And you can purchase gas in Bakersfield, California, and have it delivered in Boston, Massachusetts simultaneously. So it is an efficient market. That's the point that I wanted to make. So let's look at some of the market fundamentals that are important to us. After years of struggling to grow supplies, advances in technology have helped the producing segment to actually grow the domestic business quite a bit. What I want to show you here is just so that you get a sense of where these natural gas supplies are. And when people mention the Permian Basin or the Mid-Continent or the Powder River Basin, that you get an idea of where these supplies are located. Advances in drilling technology and other finishing methods have enabled producers to, like I said, grow the business, and one of them is, you'll hear a lot about shale plays. There's a lot of natural gas locked in the shale formations throughout the country, but it was difficult to really extract on an economic basis. Well, nothing like a little bit higher prices to change that, and that coupled with these advances in technology have made these shale plays a lot more attractive and are actually the ones that are growing the domestic natural gas production. And the reason that this all works is we have, like I mentioned, the pipeline grid to move the gas supplies from the supply basins to the markets. And the good thing is that it's kept pace by adding infrastructure where it's needed, and the efficiencies are there so that the supply and demand dynamics are as true as they can be. So if all goes as planned, here's what we see happening in the future here. We see domestic production growing. We see a wedge of Canadian imports slowly squeezing out. And you have a layer of LNG that's kind of out there as a bit of a gap filler too. That was expected to be much larger in people's minds a few years ago. I think this is a little bit more realistic depiction of what's really going to happen, and I'll get into that a little bit more, why I feel that that's true. But one other point that I want to make about the production side of the business is this slide depicts what we call like the production drilling treadmill. Newer supplies decline at a much faster rate than older supplies. So consequently, you have to drill more wells each year in order just to keep your production flat. So keep that in mind when we look at rig counts later. One last comment about supplies in the LNG value chain. As I had mentioned, people had suspected that the LNG was going to be the answer to declining domestic productions. The problem with that is a lot of things really have to happen in order for that to work. You have to have the upstream production and exploration in the host country. You have to build the liquefaction facilities in those areas to take the natural gas and cool it down to 270 degrees Fahrenheit, put it in these tankers and ship it all over the world. And those tankers take a couple years to build as well. So planning these things without the presence of long-term contracts is pretty difficult to do. So sometimes when you hear that LNG is going to be the answer, for the United States, I don't think so, because really what we're going to see is mostly distressed cargoes that have no place to go elsewhere, and will come to the U.S. from time to time. I put up a couple of factors here affecting demand. Some of them are pretty obvious. Heating and cooling demand will be a primary driving factor. But what's important to know is that these factors can be present at any time in different combinations. They can work against each other. So like the supply long-term profile, looking at the demand, we see the growth primarily coming from the power generation sector. The Energy Information Association, EIA, projects demand getting to about 25 TCF a year and then leveling off a bit. This is a little bit different than what we were looking at a few years back, where there was a debate going on about how soon we would get to 30 TCF a year. So what drives natural gas prices? Well, anytime the supply and demand balance is disrupted, that's where you're likely to see some price movements. So let's see if we can see that in action. I like this slide. What you have is the NYMEX in the blue line, and you have rotary rig counts, natural gas only, in the yellow bars. So it shows the correlation between prices and drilling activity, and vice versa. So low prices, people want to shut their rigs down. Higher prices, people want to get in on the action. But I also want to point out some of the peaks that we see here, and some of the fundamental drivers that were behind them. Early on, you had a period of relatively low and stable prices, and the what was called the gas bubble burst. The prices began to rise slightly. And then you ended up having one of the coldest winters that you'd had in about 10 years. This was 2000, 2001. I keep losing that. Well, that's that first peak there. There was another peak in the spring of 2003, which is this one right here. It was, again, weather related. It was cold, but it wasn't December or January. It was February, and storage inventories had kind of been depleted. There was still gas in the ground to withdraw, but the deliverability had been compromised, and so it really ran up the prices at that time. And so I hope you were on the right side of that March-April spread when that came around. The third peak, again, as Joel had indicated, that's the hurricanes in 2005. And I'm still trying to figure out what that last one is. So where are we headed? Well, I think storage is going to be king for a while. It wasn't too long ago we were seeing announcements such as this, and sure enough, in the last 2 weeks, we've even added some additional supplies and continue to set records each week. And we may actually test the limits of the physical storage capabilities in the U.S. So storage levels like this should be enough to buffer production declines as rig counts go down. It ought to still be enough to withstand some colder than normal temperatures this winter. So I too am somewhat bullish, or bearish rather. So in summary, here's what you have. If you look at just the fundamentals, you find some mixed signals. You've got the unconventional supplies and the LNG providing a gap filler, but they both have issues about whether or not they could be viable. You have demand expected to grow marginally, but you also have an economic recovery that could come swift and sooner than people expect. So the question is, how will the market respond to that? So with that, I'll thank you and look forward to your questions later.
Thanks, Dave. Our next speaker is Brian Marozas. Brian is also with Integrys. He's a manager of natural gas risk management. He has 18 years of experience in the energy industry with equal 6-year stints in gas supply, finance, and risk management. Brian has a bachelor's degree in math and statistics from Miami University and an MBA in finance from DePaul. Brian?
Yeah, it was the same presentation, just, that's okay. Like Chuck mentioned, I went to school at Miami University. Right now, we're 0-6 on the football team. Not doing too well, but watch out for a hockey program. We did well last year. What I like to cover today is the hedging that we do for the 5 gas utilities that Dave covered earlier. Pretty much all 5 gas utilities hedge for the retail ratepayers. And the end goal is always the same for all of them. The goal is to mitigate price volatility. So everyone's pretty much in agreement with that. So that's managing market risk. What's not well understood throughout the entire corporation is the fact that once you start going into trying to set up a hedging strategy, you introduce other types of risks. And the 2 main ones that I want to cover are liquidity risk and credit risk. So again, what are the key risks that you have to manage when you start to have any type of strategy, whether it's a hedging strategy or a trading strategy, are these 3 risks. For the utilities, we're trying to mitigate price changes for our customers. We believe that our customers would rather see stable prices over time. So let's institute some type of hedging program to do that. Well, once you start hedging and putting on trades, you introduce 2 new risks, liquidity risk and credit risk. Liquidity risk, my definition here is like the sudden cash outflow due to hedging. In other words, margin calls. Credit risk, what happens when you have an exposure to a counterparty defaulting. So once you understand that you have to not only deal with market risk when you put on a hedging program, you're going in the right direction. The next step is to figure out, well, what kind of tools do you have available to you to do this type of strategy? And for a utility, we have 3 main methods of implementing our hedging strategy. We can transact physically on the exchange or financially in the over-the-counter market. Physically, we generally trade under NASB or base contracts. And financially over-the-counter, we trade under the ISDA contracts. And each of one of these has a different impact on liquidity risk and credit risk. When we transact physically, generally speaking, you have very limited margin calls built into these contracts. However, you have higher credit risk. It's the exact opposite when you do things on the exchange. You can have margin calls on a daily basis, but basically you don't have any credit risk that you have to monitor. And then something that's kind of like halfway in between the two is when you transact financially in the over-the-counter markets under ISDA contracts. For those agreements, generally speaking, there are credit support annexes that basically set what your liquidity risk and credit risk is going to be. Once you reach a certain threshold, you have to start posting margin with the counterparty. But up until that threshold, you have credit risk associated with that counterparty. So you've got 3 risks that you're trying to manage. We've got 3 tools that we try to manage these risks. The next step is to figure out, well, what kind of strategy do you want to implement? What kind of hedge strategy do you want to implement? And so what we decided to do was build a model to basically model all these three risks simultaneously. And we built the model internally. You can probably use your own internal risk management software to do this too. But we just used an Excel-based model with a at-risk Palisades add-in tool to do this analysis. Basically, you look at the key drivers associated with your strategy. You know, what's your total purchases? How much do you plan on hedging? How much do you want to do physically on the exchange, financially in the over-the-counter market? Do you want to do fixed price, pricing, or do you want to buy calls, sell puts, or some combination of those two? The other thing is, how many counterparties do you have? Do you have 30 counterparties you can trade with physically, and 20 counterparts you can trade with financially using ISDA contracts? And how far out do you want to hedge? Do you want to hedge out 18 months, 36 months? All these things impact the three risks that I talked about earlier. Once you set up a model internally or you use your risk management system, you basically want to run different scenarios. And the main scenarios, main outputs of your model should be realized gains and losses and unrealized gains and losses. The realized gains and losses tell you how much market risk you've mitigated. Unrealized gains and losses will tell you how much credit risk and liquidity risk you've undertaken. So what we've done is we built a Monte Carlo model that just basically runs 1,000 scenarios over the next 5 years of all the different possible combinations of gains and losses with the hedging program and unrealized gains and losses associated with the program. The end goal is to be able to communicate this effectively to senior management, because the same questions keep on coming up over and over again. We've been hedging since, for at least 10 years, and we always hear the same questions. Like, how effective is your hedge strategy? How much capital, do you need in order to implement the hedge strategy? In other words, how bad can the margin calls get? How far out should we hedge? And then probably the most important one is, well, what combination of physical, exchange, and or financial over-the-counter instruments works best for us to reach our goals? So what I'd like to show you are a couple of examples of some of the outputs of the model that we've shown senior management to help us make decisions. The first one is, well, how effective is your hedge strategy? Well, we measure our effectiveness of a hedge strategy by, well, how much did we mitigate, price volatility? If we did nothing, prices would be on average about 63% annual volatility. But our current strategy reduces that to about 44%. Recently, we've looked at a new strategy that actually increases our market risk. Well, you might ask yourself, well, why would you want to increase market risk? Don't you want to mitigate market risk? It's like, well, we do, but there are other consequences associated with reducing market risk. The first one being liquidity risk. How bad can margin calls get? In this scenario that I'm showing is that the current strategy, as far as the worst case scenario, there's a 0.1% chance that we'll need $23 million in capital to support that strategy. Whereas if we were to move to the new strategy, which instead of hedging with fixed price, we end up hedging by buying more call options, we only need $7 million of capital. So it's nice to see that interrelationship between the two. And then lastly, how far out should we hedge and how does that impact credit risk? We've looked at, do we hedge out 18 months or 36 months? And each one has a different impact as far as your overall exposure. On this cumulative probability chart, it basically shows that there's a 10% chance that the total exposure will exceed $10 million if you only hedge out 18 months versus $20 million if you decide to hedge out 36 months. So all of this gets presented to senior management so that they can make an effective decision as far as what kind of hedging or trading strategy that you want to implement. So first off, know the risks that you need to manage. It's not just market risk that you're managing. Once you go down that path, at least from the end user perspective, hedging, you introduce other risks that need to be managed. The two main ones, liquidity and credit. Make sure you have a wide variety of tools to manage these risks. It's nice to be able to hedge physically over the exchange, financially using over-the-counter instruments. It's nice to just have a whole bunch of tools in your toolbox to hedge. And then try to build some type of model or use your risk management system to analyze the costs and benefits associated with your hedging program, because it's a lot easier to walk into a meeting with senior management and show them objective data and say, well, here's the result. If you want to hedge using this strategy, here's the impact as far as reducing risk and margin calls and credit exposure. So that's all I have.
Thank you, Brian. Our final speaker is Vince Kwasniewski, and Vince is COO and General Manager of Illinois River Energy, a 100 million gallon per year corn-based ethanol business that is based in Rochelle, Illinois. In a career stretching back to 1991, Vince has worked at Amoco in the olefins and refining business, in the olefins business at BP, and in marine logistics at Innovine USA. Vince is the holder of 4 patents, and he received a Bachelor of Science with highest distinction in chemical engineering from Northwestern University and a PhD in chemical engineering from the University of Minnesota. Vince?
Thank you, Chuck. This is going to be a little different here. It's the first time I saw the other presentations, and I'm kind of the color commentator. I got lots of nice little pictures here, so hopefully this is fun for you. Chuck mentioned I work for an ethanol producer in Rochelle, Illinois, which, if you don't know where that is, it's 80 miles west of Chicago. And I guess you can look at my presentation as really kind of an example of an industrial user, and maybe an interesting one as well. One that has one foot on the energy side, which is our ethanol, which goes into fuel, as well as the natural gas we use that I'm going to focus on here, and the other foot in the ag side, with the corn that we use and the byproduct animal feed we make. So if any of you also do stuff on the ag side, maybe it's even more interesting. So lots of pictures here just to show you a little bit about this business, and not as many charts and numbers, but I certainly can answer questions afterwards about that if you like. Title slide here just shows a picture of our plant out in Rochelle, conveniently with a cornfield in the foreground, which there are a lot of out there. And I'll tell you a little bit about the equipment out there, but you see some of the features that are common in the plant that, rail cars for moving the ethanol, the plumes there, which is what's where you're seeing the natural gas combustion products coming out, and then all the processing equipment. I worked for BP and Amoco in refining and chemical plants, and corn ethanol plant is conceptually very similar. Instead of crude oil as our feedstock, we have corn. Instead of making gasoline and distillate as our products, we make ethanol and an animal feed product. And just like a refinery, we use a lot of energy to do it. Okay, so here's corn ethanol for dummies in picture form. And I had this originally for politicians when we were seeking grant funds. I thought of crossing out dummies and putting politicians in, but you can pretty much catch up with them here. What you see on the left is the field corn product that we've got, which you can also see that's a hopper dumping into a pit from a truck. All our corn comes from trucks, as most of the ethanol plants do. Contrary to refining, where you move your feedstock great distances in pipelines, the logistics of moving the agricultural feedstocks around, it's generally prohibitive to move them very far distances, and really trucking them within a 50-mile radius really is the most economical way to go. Few plants do trains, but it's mostly truck. A nice little creative natural gas burner there. And then the big pile you see there on the left with a human form there, if you can pick her up, is the animal feed product, which it's called distiller's grains. And then the ethanol tanks and a truck rack down there at the bottom, which doesn't look all that different than a small refinery. So here's my one complicated slide that I was going to pull, but I'll try to walk you through a little bit in case you're interested in the process. The corn comes in, it's ground into a flour up there in the corn milling section, and then mixed with water and enzymes to make a called a corn mash. The enzymes start to convert the starch into sugars that the yeast can ferment. And that's the slurry, cook, liquefy section. And that's all continuous at most plants, our plants as well. And it goes into fermentation, which most plants like ours is a batch fermentation where separate tanks that sit there and go through the whole reaction process completely, as opposed to flowing continuously through it, and then they're dropped out of there. From the fermentation, it goes back to continuous, so it starts to look like a refinery again, where that we call it a beer now, but you would never want to drink it. It's nasty stuff. But it's ethanol, water, and unfermented unfermented corn, the protein, the fiber, and the fat that's in the corn. Goes into a distillation column that takes overhead just a water ethanol stream that gets further dried down in some process equipment to produce the finished ethanol. You also denature it a little bit so nobody can drink it and get drunk, but I can't believe anybody would want to drink it anyway because it's still pretty nasty. Out the bottom comes the beer, the solids, and the water, and any dissolved material in the water, amino acids and the like. Water gets spun out of it like you would in a washing machine, the centrifuge equipment. And then what comes out of that is a wet feed that you can feed directly to cattle or hogs if you have enough in the area. Most of the part of the country that produces ethanol doesn't have enough livestock to do very much of that. It's a product that spoils. Nebraska makes a lot of wet product, but most of the other areas will take that product into some dryers. I've got some neat pictures of that dry it down to the dry product that you saw on that first slide. The dry product, again, it's an animal feed. That's kind of something that's lost on a lot of the detractors of ethanol, because 1/3 of what you get in the corn goes back into the feed supply, and it's actually the good third. It's the third that's got the energy from the fat and particularly the protein that helps build the muscle mass in the animal. DDGS is shorthand for dried distillers grains with solubles. There's a syrup stream that gets dried back on that as well. Those dryers are a gas-consuming unit at the plant. I'll show you in a minute in a picture. The biggest gas-consuming unit in the plant, however, are the boilers that generate the steam that runs all the processes. Slurry cook is a hot process. Distillation is a hot process, and so is the dehydration in molecular sieves. They're also, and that's a pretty ugly looking smoky stack, but the plumes we have are not smoky. That's all water vapor, because coming out of these dryers, there's also volatile organics that are hazardous air pollutants, ethanol being one of them, but there's some other byproducts in the fermentation reaction that are ozone formation agents and things like that. So we can't just vent that out. And our plant, and all the plants really, have to do something to destroy that. And in our case, it goes into the boiler, which is doing double duty as a thermal oxidizer to thermally destroy those organic compounds. So there, that's my one long slide. Now we go back to fun pictures. The one on the left is one of 2 boilers that we have being installed at our plant. Our plant was expanded last year, so I got lots of good pictures of it back then. And that plant, and I don't know what units people speak here. As an engineer, I know a little bit of chemistry and engineering left. Millions of BTUs is the unit that we generally speak in. And we have 2 of these boilers at our plant. They're about 3,000 million BTUs a day each, which is about 2/3 of the gas that we consume. And on the right-hand side are a real fortunate picture we could get, because the equipment is all enclosed in buildings now, but when you're building it, you can take a nice picture from far away. So this is a picture through the wall that hasn't been put up yet of the drum dryer. So these are big cylinders on their side that spin around, and they get hot gas blown through them, gas that's formed by just a burner. The burner is up, where's that little pointer? The burner is up right there, and the hot gas flows this way through the drum, and this drum rotates. And coming out the end is the dried product. And we have 4 of these, and they each are around 750 million BTUs a day. So if I did my unit conversions right, because I never think in MCF, but I think I did this right, it's about 9 million cubic feet a day at our plant. So, you know, in the grand scheme of things, the numbers that you saw on the other speakers' charts, this is a really small drop in the bucket. But there are about 210 ethanol plants in the country today. We're bigger than average, but not. We're kind of the size that the last 50 were about. So there's a lot of them around, and how it kind of adds up. Oh, this slide pulled in here too. Just a couple other statistics, and then I think I have one on the industry. You know, we just to scale it a little bit to refining, where you have refineries that talk in barrels a day. Ethanol, they never talk in barrels a day. They talk in millions of gallons a year. I think they like big numbers. So we're at 105 million gallons a year, but on a refinery scale, that's pretty piddly. It's about 6,800 barrels a day. And again, we're a bigger than average ethanol plant. I'll skip over the other two. I don't know if you're calibrated to ag units, but the numbers there on natural gas are the same units the same numbers I had before, but on a year basis, you'll see we're about 3 BCF per year at our plant. The ethanol plant locations, I guess this is important for the natural gas industry because you know, this is where the physical gas has to be delivered, and ethanol plants are located where the corn is. Surprise, surprise. There are some attempts to put these plants at the destination markets, they call it, out here on the coasts where there's a lot of consumption. That's a failed business model, and you'll notice by the idle colored dots, the idle colored dots are concentrated more in the destination markets than they are on the heartland, because a lot of these, on a percentage basis, a lot of these plants are not economical. But you can see the kind of the epicenter is right in the heart of the Corn Belt here in western Iowa. And our plant would be this one right here. Like I said, there's 210 of those plants there today. About 25 are shut down, mostly, not all bankrupt, but mostly for financial reasons of one sort or another. It has been an industry that has been challenged a lot over the years. There's really 3. I only bring this up here because you know, if you're looking at how ethanol might impact the gas markets, the question might be, you know, what's going on with this industry that was at least at one time a hot industry? You know, is it growing a lot? And I guess the answer to that would be we've had our struggles, but it will be growing because there's a mandate for it to grow. And there's really 3 big regulatory or tax considerations. The first and foremost is this renewable fuel standard that obligates blenders to use an increasing percentage of renewable blend stocks in their fuel products. RFS 2 started in 2009, which is why that range started. The lower number on the range is any biofuel, which pretty much means corn ethanol, because all the other ones are not very economical. And the higher number is if you add on top of it some of these specific biofuels that are specified, like advanced biofuels or cellulosic ethanol or things like that. And you can see that the mandated amounts are going up every year until 2015. This year it's 10.5 billion gallons of mandated amount. We're going to probably be at about 10.9 for the year, and next year it goes up to 12. After that, the pace of increase drops off quite a bit. The other 2 there that are less important, but they're still there, these are ones that are expiring, are the blender's credit that provides an incentive to blend ethanol. Was originally intended to help the blenders build the infrastructure to blend the ethanol. It does go to the blender, it doesn't go to the ethanol producer. Who knows what they're really spending it on, but supposedly it's to incent them to put in infrastructure to blend ethanol. And then there's a secondary tariff that roughly offsets that volumetric excise tax. And the Corn Belt politicians will say it's so that we don't subsidize Brazilian ethanol, the Brazilian guys will say it's an unfair tariff. You can decide for yourself. Both of them are set to expire next year. I wouldn't be surprised if they were extended in some form, probably at different lower numbers. Okay, this is the one I wanted to show. So about 10.8 billion gallons in 2009, which is roughly the size of, I don't know, 2 or 3 refineries. About 75% of the ethanol is like the schematic I showed. The rest of it is variations that might use a little more gas, might use a little less gas, might not use any gas. Some ethanol plants are coal-fired. For the kind like our plant, they use about 0.3 million BTUs per gallon. So just using that simple number and then a slightly smaller number for the other 25%, just to keep pace with the RFS mandated levels, the amount of natural gas consumed in ethanol would be that bottom line. So roughly 300 billion cubic feet for 2010, and going up to 420 billion by 2015. So still relatively a drop in the bucket, but a growing drop in the bucket. That wasn't one I was going to talk about. Okay, so the historical margins. The only reason I bring this up here is to kind of show you that there really isn't a big correlation between natural gas and ethanol margins. Corn is the biggest cost to an ethanol producer. Natural gas is the second biggest cost, but it's way smaller than that, and it's also one that a lot of people don't track. So down here on the trading floors, a lot of people talk about the crush margin, corn and ethanol. They don't even consider the distillers' grains or the natural gas. But so what that means is basically gas prices, they can squeeze us if they go up because the ethanol price usually doesn't respond to it. Conversely, if the gas price goes down, our costs will go down, and it isn't always picked up by the market, and we can have margins that increase. You can also see that our margins are extremely volatile, and there are even times, and this is a gross contribution margin, so there are additional costs below the line for this. There are times when we're deep in the red. I know that's not unusual for a lot of businesses nowadays. But again, it's an example industrial consumer that uses natural gas, but it's one that kind of is the tail of the dog. Natural gas is going to do what it does, and we're just going to have to live with it. We're not really impacting the natural gas market substantially, I would say. I think that's all I had, Chuck.
All right, thank you, Vince, and thanks to all the panelists. What we'd like to do is open the floor for Q&A, and we don't have a microphone for the audience, so what I'll try to do is repeat the question so everyone can hear it. But if you would speak up and direct the question to the panelists as appropriate. I could start. I'll get things flowing here a little bit. Dave, you showed one thing about the large decrease in the drilling rigs for natural gas, and I wondered if you'd comment on if you think prices are going to rise as a result of the dramatic drop in drilling rigs, and if so, how high will they go?
How high will they go? That's the $64 billion question, I guess. The old saying that the best cure for low prices are low prices, I think is going to eventually hold true. People will start to shut in more and more rigs if they don't see enough relief, but I think that's something that's still down the road. As I mentioned, I think storage is still going to outweigh that aspect of it for a little while. And but I think it's at some point the prices, the producers will not make enough money that they'll all start to shut in until they get some price relief.
Okay. Any timing on that, or still a dynamic?
The number of rig counts have increased a bit over the last several weeks. They're off the low for the year, so. It could come, it could be delayed, at least till the spring, but, the worst thing to do is to make any prediction, so.
Okay. Any questions out there?
Are any of the LNG terminals that have been built in recent years, are any of them set up to export gas to Europe?
So the question is, of any of the LNG terminals, the liquefied natural gas, that have been set up to import gas, are they also equipped to be able to export gas? Basically what you're saying, but the story behind that is that 4 or 5 years ago, there was the belief that we were running out of gas, and the unconventional methods have boosted production so that we now have more gas, and we don't need to import the LNG. So,
And the Europeans are desperate to secure natural gas supplies. They're dependent on Russia.
and the Europeans are dependent upon Russian natural gas and interested to get imports. So I don't know if anyone could take that.
I'll try. I'm not aware of any North American plans to construct LNG export facilities. There was an idea that we could do one in Alaska, and rather than transport the natural gas via a Alaskan pipeline to the lower 48, that they might build an export terminal and just ship it down to California, but that never got off the ground, and I'm unaware of any others that are even on the drawing board.
Any other hands? I had a question for Joel. Given that the inventories in the distillate or the heating oil are so much higher relative to both crude oil and gasoline, one impact, if any, is likely is that to have on the relative prices of those different products, distillate, gasoline, and crude oil going forward?
Well, right now the crack spread for the distillate is actually higher than the gasoline, a little bit partly coming into the heating season to do that. But the relationship between gasoline and heating oil, or RBOB and heating oil, is a very dynamic one and a very tricky one. In fact, it used to be called, when it was HU for gasoline and HO for heating oil, it was called the hoo-ho or the ho-hoo spread. And it was also called the gambler's ruin, because one thought they had a sense of how those two would be moving with each other or against each other, and it just didn't happen. So I guess I'll have to plead innocence there, that I don't see a strong relationship that I could see based on fundamentals between the price action of the two.
Vince, I had one question on just on ethanol in general. It's been I think you alluded to it. It was a real boom several years ago, but went through a bust cycle here that ran through last year. Now back on the rebound, first from lower corn prices and now from higher demand. And do you see that type of cyclical nature is inevitable in the market? And based on what you think, what are your shorter-term projections for what ethanol prices are going to do?
Yeah. Okay. Well, kind of a corollary to the best cure for low prices is low prices. The best cure for low margins is low margins. And what's happened in the ethanol industry is that there was a big boom of construction around the legislation that mandated renewable fuels. In fact, it's pretty amazing how much capacity was built. Back in 2006, there was 4.9 billion gallons a year of capacity, and today there's a 13.1. Just in 2007, the capacity grew by 42%. So there was a lot of money that poured into it. I think a lot of it was ill-conceived. The market really couldn't absorb that much capacity. It was overbuilt. It got ahead of the mandate by a long shot, and what ended up happening was that it couldn't sell it all. The infrastructure wasn't available to blend all the capacity that was there, and a lot of plants shut down, and quite a few of them went bankrupt. That's squeezing the excess out of the system, and there's very little capacity that's on the drawing boards right now. I said there's 210 plants today. There's only 8 to 14 under construction right now, and the demand should increase faster than the additional capacity, and capacity utilization ought to go up in the industry. Now, new money can come in, but I don't think people are going to get fooled twice on that, because what's kind of hurt ethanol was it was a darling. Everybody loved it because they hated oil, and investors thought, well, all I got to do is put my money in this green investment, and the public will love me, and things will be great. Well, then of course, once it gets big enough to have any impact, there's a lot of detractors that surface, and there's been a lot of attacks on ethanol, and they've had some impact. I won't go into those arguments, but investors now are a little wary that ethanol is going to have the support that it has historically had, and I think they're not going to pour all the money into it because they've been burned once. There'll be some cyclicality to it, but it will not be as big as what it was this first time around.
All right, one question for Brian that struck me, Brian, is you talked about, potential gains and losses, and regulation is a huge topic in the energy business now. There's stop oil speculation and the like. In your line of business, how do regulators view gains and losses that you have as in your portfolios?
The regulators we deal with generally understand that we're not putting together a strategy or a trading strategy to try to outguess the market. We're not trying to improve the bottom line. It's not about P&L. It's more about mitigating price volatility. So they're well aware that the main goal is mitigate price volatility, and that half the times you're going to lose, half the time you're going to win, and in the long run, what you're trying to do is just stabilize prices for your end user.
All right. Any other questions from the audience? Yeah?
Brian, you mentioned that there's some connections between credit and liquidity risk. How do you handle the risk correlation in your modeling?
The question was, there's a connection between credit and liquidity risk, and how do you manage the correlation between the two in your model?
Well, built in the model is basically a Monte Carlo analysis of forward prices. So I look at how forward prices can change over the next 5 years, and I explicitly actually model what the credit side of the equation is versus what the liquidity side of the equation is. And generally speaking, they act in exact opposites, because on the liquidity side of the equation, it's pretty much, okay, how much collateral do you have to post? And on the credit side, it's, well, if you've got an in-the-money position that you haven't received collateral, how big can that get?
Anyone else over here?
Brian, do you see you talked about using call options more in your hedging strategy. Now, do you see that as a trend with utilities?
The question, if I can just repeat it, he said, Dave talked about using call options more in his hedging strategy. He wanted to know if that's more of a trend with utilities in their hedging activities.
I don't know about all utilities, but definitely at Integrys Energy Group, it is. It's what we're trying to do. Obviously, when you go through the process of mitigating price volatility, there's another goal, which is to try to protect ourselves against catastrophic price run-ups. And call options are just perfect for that. They act as insurance products. If we're really worried, we're okay with prices being $6 or $7 a decatherm, but if we're worried about prices going beyond $10 a decatherm, why not buy some insurance right now to protect ourselves? So that seems to be the thought process at our company.
I've got a question for Joel. Are there any physical constraints to the distillate storage facilities, like in that gas with maximum?
The question is, are there any constraints to the distillate storage facilities? In natural gas, you may have a physical constraint on how much you can actually store. Does the same apply to distillates?
There really aren't any physical constraints. There actually are physical constraints on the gasoline because there are different kinds of gasolines that can't be mixed together in storage. With the EPA mandate that all distillate eventually is going to be ultra-low sulfur, less than 15 parts per billion of sulfur, and all the tanks being cleaned out, there basically isn't an issue there. It's a greater issue of just carry cost, and there really isn't enough carry in the market right now, so it actually hurts to store. So there's a kind of a tug of war between the financial consideration and just the oversupply.
Anyone else in the back over there? The question was to Vince is what extent do you use futures to manage the risk in your inputs?
Yeah, we do use futures and options on the corn side as well as on the natural gas side. And our strategy is like what a lot of producers have. We're trying to just manage the margin. So we're not looking at whether, we're not trying to make a call on whether the market's going up or down. If we have a margin that we like in a forward sale of ethanol, which we generally do just physical sales on ethanol, the over-the-counter markets and the exchange markets don't really have enough liquidity to do the kind of volumes we would need to do. So if we have a physical sale on ethanol that's on a fixed price, we would go out and we'd look at various ways to hedge that, and it could be an option strategy or just a straight futures.
How do you handle the contango, like in the natural gas market when it gets real steep as far as, hedging out your price risk, onto the future? I mean, do you just pay up on it, or,
Yeah, if we did it, we would pay up on it, but the margins on the ethanol industry have generally been, because of things like that, there's also usually a pretty decent contango in the corn market as well. Deferred margins have not been very good in the ethanol industry. The prompt margins have been much better, so most of our sales are really very near term.
In case you couldn't hear it, there's the question after the answer, but the question was how you handle in the hedging with when you have a strong contango market, or how do you absorb that cost? And that was the answer. It's like Jeopardy. First you get the answer, then the question. Yes? Brian, I couldn't hear that. Can you repeat it?
Sure. She asked, as a percentage, where do we do our hedges? Do we do it more physically, financially over the counter, or on the exchange? And it really does depend on the utility. People's Gas and North Shore Gas tend to hedge more financially over the counter, like you said. But some of our other utilities favor the exchange or the physical markets. So it's really dependent upon the individual gas supply manager in the state that's trying to manage it. At the end of the day, they have to report what their activities are to the regulators, and they try to get a sense from the regulators which method they think is the best.
All right. Anyone else? All right. Well, oh yeah, go ahead.
Joel, just what's your take on WTI price behavior versus other light sweets like Brent or LLS in the last 6 to 9 months?
The question is, what does Joel think of the behavior of WTI prices to other light sweets such as Brent or LSS in the last 6 months?
It would be an understatement to say that WTI has been kind of squirrely, and that Brent, because of that contract's lower volatility, has actually been a bit more stable. There's been talk at switching because we're basically running out of WTI as a benchmark, and they're looking at either LLS or some other, maybe a sour crude. But yes, recently it's been very, very volatile compared to the other markets, to the extent that certain crack spreads and hedges are put on against Brent rather than against WTI.
All All right, well, thank you all for coming. We have, I'd like to thank Angie DiCarlo. She's here representing the CME. So if you have questions of the CME group and NYMEX or AGS, we touched on AGS. We'll drag you into AGS, Angie. There's also a number of representatives here from Advantage Futures and several of us from Fundamental Analytics. We're going to be staying around here. There's refreshments, some light snacks. If you'd like to talk and network, please do so. Thanks once again for joining us, and we hope to see you soon.